Welcome to Fred's Financial Planning Workshop, a series of talks covering a wide range of topics. Today we kick off the series with a big picture overview of our agenda. I'm Fred Smith with the Silicon Valley chapter of the AAII, and the slides for today's talk are available at our website, www.siliconvalleyaaii.org, and feel free to email me if you have any questions or comments at the email address here. This is our standard disclaimer. Basically says that these slides are for educational purposes only, and the opinions expressed are mine and not necessarily those of the AAII. So let's get started. This is the first of a series of financial planning workshops. We're covering the big picture and an overview today. There'll be a live Zoom webcast workshop for all of these on the second Wednesday of every month, and you can get details at our local chapter website. We'll be covering investing, taxes, retirement planning, insurance, and estate planning. So for today, we're going to start off with a quick look at life planning, the view from 30,000 feet, and then we'll cover the 5 pillars for your financial plan: investing, tax planning, retirement planning, risk management or insurance, and estate planning. Just a real quick hit on these 5 pillars. And then finally, we'll wrap up with a look at how to hire a financial planner if you think you need one. Life planning is a matter of aligning your dollars with your values. It's difficult to make a plan for the future, unless we define where we want to go. I think Yogi Berra said it best: if we don't know where we're going, we may end up someplace else. So first, you want to define the life you want to live, and recognize that money is merely the means to that end. It's not the end in itself. One way that may help you to formulate your thinking on what your life plan should look like is to check on George Kinder's 3 big questions. I actually suggest that you Google Kinder's 3 big questions, because there are a lot more detail on the website than I can cover here. But in essence, his 3 questions were very simple. The questions are simple, the answers are not. How would you live your life if you had plenty of money? If you have plenty, money is no object for the present or for the future. How would you live your life? What would you change if you had only 5 years left? And the final question is more somber. It would basically be that if today was your last day, what would you most regret not having done? So I suggest that you want to take some serious thought for these in a nice quiet corner, and you should actually write down the answers, because it's a lot of soul searching. It's not easy, but it's worthwhile. But that's what helps to define what your life plan is all about, and how your financial plan fits into that. Okay, looking at the 5 pillars of financial planning. The first one is investing, and the first thing you need to do is to write your PIP, your personal investor profile. For your PIP, it should only be maybe half a page. It's not a very big document, but you need to define your age, your time horizon. Have a look at your risk tolerance. You maybe want to even fill in some of the risk tolerance questionnaires that are available on all the major financial websites. Your tax status fits in there. Are you in the AMT or not, and stuff like that. The next document is a little more comprehensive. It's your investment policy statement, your IPS, and that should include the goals for how you want to manage the account, what asset classes you intend to use. The most important feature in here is the asset allocation amongst those classes. How much goes to equities, how much goes to fixed income. And you should include the trading rules as well. In other words, what are the rules that you would use to buy a security, and what rules do you use for selling? Once you have those two documents in place, and you really do need to have them in writing. If it's not written down, it never happened. Once you have those two in place, it's easy enough to define your portfolio and pick specific funds for each account, based on your PIP and your IPS. And then you implement the portfolio, just go online and make all the purchases. And then the final item, final step on the investing process is to monitor your portfolio on a regular basis. Now, regular can mean, every 6 months or a year. If you have chosen a passive approach of putting together a diversified portfolio of index funds. On the other hand, if you're an active investor, you may want to monitor on a weekly or monthly basis. Some folks even look at it daily. But that should all be spelled out in your IPS, and that's what you should look to as to how you monitor it. Okay, what I'm trying to show here is the universe that's available to investors, and it's based mostly on the frequency of trades. If you trade out here, on the left-hand edge of this, trade on an annual basis, if you're mostly a buy and hold or a buy and rebalance investor, following modern portfolio theory, you'll be out here in this bottom left corner. If you're a contrarian investor that invests mostly in stocks that are out of value or dividend investing, you're likely to be trading less frequently, probably on the month category. Active investors typically follow momentum strategies, picking growth stocks and using market timing. So that's likely to put you in the area where you're going to want to monitor your portfolio more frequently, at least monthly, possibly weekly, or more often. And then finally, if you're if you're a speculator doing day trading, you're way out here on the right-hand edge, and that's a high trading corner. For those folks who want to look at passive investing, in other words, building a diversified portfolio, the portfolio will include fixed income, will include, that's shown in green here, will include domestic equities shown in red, then international stocks or emerging markets shown in blue. And you may have, a very simple portfolio might consist just of 3 index funds, one for the total bond market, one for the total U.S. stock market, and one for the international stock market. That's perhaps a portfolio that's a little too simple for a lot of folks, but if you want to split them up, you can obviously take your fixed income. Instead of having one bond fund, you could have 2 or 3. And then for the domestic stocks, the same thing. You might have large cap and small cap stocks. You might include some real estate. You may even include some commodities in there. And for the international stocks, you can easily break it down as to for the developed markets and for the emerging markets. If you find that you're going beyond 8 or 10 funds, you're probably over diversifying, and you're giving yourself perhaps more work to do than is necessary. I actually like the simple 3-fund approach. One for total bonds, one for total U.S. stocks, and one for the internationals. Let's look at the difference between passive and active strategies. I've defined a passive investor here as somebody who builds a diversified portfolio of cheap index funds, and by definition, they're going to get the market return, less a small expense. For these index funds, the expense is typically 0.1% or less. Usually significantly less than 1/10 these days. And the distribution of all investors aiming for the same market would be fairly tight because they're all aiming for the same market return, trying to replicate the market. An active investor, on the other hand, just very simple definition, somebody who is not a passive investor. So, obviously when we do that, the passive investors plus the active investors make up the total market. The active investors on aggregate will also get the market return less an expense ratio. And typically for the active investors, they're looking for more esoteric securities rather than just index funds. And the expense ratio may be a little bit larger, but the distribution of the active investors will be all over the map because they're aiming for different targets. Some will be aiming for large cap, some for small cap, some for value, some for growth, and so on and so forth. And what I'm trying to show on this slide here is the sort of distribution that you might expect. This is just hypothetical. I'm saying that if the market return is 10%, the passive investors shown in green here will all be clustered around that 10%, or actually a little lower because of the expense ratio, maybe 9.8, 9.9, 9.95, that sort of area. But you should get a tight distribution. For the active investors, the distribution will be a lot wider. They're all trying to beat the market, and some will be successful and some won't. Some might think that the growth stocks are the place to be for this year and have placed a heavy bet on growth stocks. And if they're right, they'll be up here. They will, in fact, have returns that exceed the market return. But on the other hand, some will have guessed incorrectly, and they may have thought that value is the place to be, and they will wind up down here. Maybe the other way around, of course. You just don't know. I'm saying that for every active investor that's successful in beating the market, there'll be somebody who has failed to beat the market. You can't have the same cases, Lake Wobegon, where all the kids are above average. Not all of the active investors can beat the market. So you have a choice of whether you want to get a fairly predictable market return, or whether you want to take a shot at beating the market and maybe be successful and maybe not. And in practice, if you look at the data shows that roughly 1/3 of the active investors in any one time period will beat the market, and typically 2/3 don't. So, the numbers vary a little bit depending on what the market's doing, but over an extended time period, roughly 2/3 of the folks who try to beat the market fail to do so. And that includes all the professionals as well. It's not just the individual investors. So keep that in mind. The odds are against you. It's possible to beat the market, but the odds are against you. Okay, you need to ask yourself, who's on the other side of the trade? If you're an active investor and you think that you have this great stock that's going to outperform the market, you need to figure who's on the other side of it. And that it could be some of the professionals in pension funds or endowment funds, mutual funds, ETFs. It could be an individual investor, and I've broken them into two categories: the smart and the not so smart. But you have to ask yourself, do you have an unfair advantage over the guy on the other side of that trade? Do you have better data? Are you smarter than he is? Do you have more experience than he has? If you feel that is the case, then maybe you're making the right move. If you feel that that's not the case, you have to wonder whether you truly want to go through with that trade. So the question comes down to, a simple issue. Are there enough not so smart individuals out there to take on the other side of your trade? Or are you going to wind up trading against these guys, the full-time professionals, and that may be a little tougher. Charlie Ellis has summed it up by comparing it to asking the question, how much would you want to bet on a tennis match if you were playing against a full-time professional? Same thing applies here. So that's all we're going to do on investing for today. We'll do a deeper dive at a later talk. But the takeaway for today, I've got two. Number one, if your IPS is very complicated, you may have a problem with it, especially if you want to have the same policy, the same strategy followed if you become incapacitated and have your agent or your power of attorney do it. One simple test is to see if you can do a quick summary in 10 words or less. What I've shown here is mine. It's build a diversified portfolio of cheap index funds and rebalance annually. That's about as simple as you can get. It makes it very, very simple for my power of attorney agent. If I become incapacitated, because they don't have to do anything immediately, and they've got months or years to get back to looking at it and see what changes they want to make. I want to end up investing with Charlie Ellis's quote of the day. If you must play the market to satisfy an emotional itch, recognize that you're gambling on your ability to beat the pros. So limit the amounts that you play with to the same amounts that you would gamble with the pros at Las Vegas. Good choice of words. Okay, second pillar we're going to talk about is tax planning. And there are a couple of acts that have occurred in the last couple of years that have changed our tax environment a little bit. I need to cover those real quickly. The TRJA, the Tax Reduction in Jobs Act from a couple of years ago, the big item there was that it reduced the corporate tax rate from 35% to 21%. And it also included a 20% deduction for certain pass-through entities that we're not going to cover today because it's far too complicated to get into. For the individual federal taxes, the rates were reduced slightly, but don't get your hopes up too much. And also the standard deduction was bumped up. But those pluses, there are a couple of negatives that offset it, or more than offset it. The state and local taxes have been capped at $10,000 for states like California and some of the states on the East Coast, New York, whatever. That's a huge big hit. It costs you seriously when you're filling out your 1040, and the personal exemption has been eliminated. So putting it all together, in spite of the reduced taxes, you're likely to actually be paying, in spite of the reduced tax rates, you're likely to be paying more in actual taxes. Other thing that happened with the TRJA is that the IRA conversions can no longer be recharacterized. Once you've done it, it's cast in concrete, and you can't undo it months later if it turns out that you'd rather not have done it. The other big item on the TRJA was for estate taxes. The exclusion got doubled up to 22 million and change for a couple, and that's great. It means that most of us don't need to bother with the estate taxes, except that there's a sunset clause on most of the items on the TRJA. It goes away in 2025. So I leave it to you to figure out how useful it is to have a large exclusion on your estate tax, if and only if you use it before 2025. Not a good choice. Okay, the other act that's recently been enacted is the Setting Every Community Up for Retirement Enhancement, the SECURE Act. I think Congress probably puts more time in figuring out these acronyms than they do in figuring the details of the act itself. Big item there was for traditional Iras. The age limit has been removed for contributing. As long as you're working at any age, beyond 70 and a half or 72, as long as you have earned income, you can contribute. And the other item that's useful for some of us is that the RMD, required minimum distribution age, has been bumped up from 70.5 to 72. So that's a useful help. Inherited IRAs have taken a hit. The stretch IRA used to be a real neat concept where you could pass your IRA on to an heir that was 1 or 2 generations younger than you and have them leave that in place for decades. But that's no longer available. Except for certain cases, the surviving spouse of the original owner can still do that. But that's obviously the same generation. And a minor child or disabled person, the stretch IRA still holds. Everybody else, it must be distributed totally, completely within 10 years. Doesn't have to be done equally over the 10 years. You can leave it all to the last minute if you want to, but that's probably not a good plan because you're going to take a big hit on your income tax for that year if you do that. The other thing that the Secure Act did was to make a safe harbor protection for corporations that are setting up 401ks and such retirement accounts to use annuities. They've removed a lot of the risk and liability that corporations had before. And that makes it more likely that would be one of the options that they can offer you. I want to talk for a minute about tax efficiency. Every asset can kind of get dumped into the one of 2 buckets, either a tax efficient or a tax inefficient bucket. The tax inefficient ones are things like CDs and REITs and to some extent bonds that spin off interest and non-qualified dividends, and these are going to get taxed as ordinary income at up to a 37% maximum these days. They're obviously most suitable for tax advantaged accounts. The tax efficient assets, muni bonds are the first thing that come to mind there because of the tax shelter, at least partial, perhaps total. Also for stocks that you hold for the long term, and those that spin off qualified dividends. These can be, the long-term capital gain is going to be taxed at the preferential rate with a 20% maximum instead of the ordinary income rate. And they're obviously suitable for the regular taxable accounts. I put together a table here trying to summarize the differences between your 3 types of accounts. I believe strongly in tax diversification, and that's what I'm trying to work into here. You've got a traditional IRA where the contributions are deductible, but the distributions later are taxed as all taxed as ordinary income. At the other extreme, you've got the Roth IRA, and the income, the contributions are taxed before they go into the Roth. But once they're in the Roth, there no further taxes owed. So that's a big help. In between the two, you got the taxable account where contributions into those accounts are going to be taxed as ordinary income. Distributions can be taxed either as income for the interest and dividends or non-qualified dividends. Also, any capital gains will obviously get taxed at a reduced rate. If these are left to your heirs, the treatment varies from one account to the other. The worst are the traditional IRAs because every penny that your heir takes out is going to be taxed as ordinary income. The best is the Roth IRA because every penny that your heir takes out is going to love you forever because you pay no tax on it. Taxable accounts are almost as good as the Roths actually because of the step up in basis. The cost basis gets a step up on death, and it means that any of the assets that are sold immediately will not be taxed, and if they're held later, the only taxes owed will be what has been generated after the day of death. And so what I'm trying to show here is how best to allocate your your assets into these three accounts. I'm saying that for your traditional IRA, it's worthwhile putting your tax inefficient assets in here because you're going to be paying ordinary income tax on them anyway, so there's no additional hit if you do that. At the other extreme, it's worth putting the high growth funds, normally the high risk funds, as well, growth and risk go together. Maybe REITs and emerging markets and stuff like that, long-term high growth funds into the Roth, because all that growth will be sheltered. You're paying taxes on the seed, but reaping the reward later after the growth tax-free. And then in the middle, you have the taxable account to absorb any of the stuff that doesn't fit cleanly into the other two. So the takeaway for taxes, I'm a little cynical, in this regard. So I think the tax world is extremely uncertain, and I believe strongly in diversifying between the three different types of accounts. It means that you won't be a real hero and guess absolutely right, but it also means you won't be a goat and get everything wrong. Okay, the third pillar on our for our financial planning is retirement planning. We're looking first of all here at the accumulation phase, and the first message is start early. If somebody starts at age 20, 25 or whatever and manages to save 15% of their earnings per annum for the next 30, 40 years, it puts them in a good position for retirement. If you save less than 15%, you may not have enough at retirement to continue your same standard of living. So if you want to work for 35 years or whatever, and then retire for 35 years, you need to save 15% per annum on average. You may start off a little lower in the early years, but then work up to it. You need to save on average 15% per annum in order to maintain your lifestyle. I've listed the tax advantage savings accounts here in the attributes. Most of you know those, so I'm not going to read through it. And then you have the Roth IRA and the Roth 401k, where you contribute after-tax dollars and never pay any taxes on it. You need to be a little careful about the RMD. For a true Roth IRA, there is no RMD for the original owner, but that's about it. For an inherited Roth IRA, there could well be RMDs, and for the 401k Roth, for the Roth 401k, I think there are RMDs. So be careful. The no RMD rule only applies to a Roth IRA for the original owner. During the distribution phase, it's easy enough to define the income from our three-legged stool: Social Security, pension. If you're really, really lucky, then the rest of it has to come from portfolio income. The expenses split fairly easily into basic expenses that you need for living, and then discretionary spending over and beyond that for travel and entertainment and so on. And the difference between your income and your retirement, that shortfall has to come from your retirement portfolio. So the question comes up, what's the safe withdrawal rate from that? And folks talking about Bengen's 4% rule as the starting point, and also the bucket approach outlined. Well, I think Christine Benz does the most useful description of how that works. But we'll be covering that at a later point, later talk. Most financial houses offer software to work through all of this, and that's a useful starting point. Some are more complicated than others. Some take a little longer to work through. And if you really want to do it, you may need to build your own personal Excel spreadsheet so that you can put in different incomes and different expenses over the years to cover your go-go, no-go, or go-go, slow-go, and no-go years. I want to talk real quickly about the RMDs. I said it applies to all accounts except for your Roth IRA. And that's now moved out to age 72 as the first year you have to take it instead of 70 and a half. It's a little confusing if you go to the IRS and look up the tables, because the table that most people want is table 3. Table 2 applies for the Roth or for the IRA owner if your spouse is 10 years younger and the sole beneficiary. Under those conditions, the IRS cuts you a little slack, and the table 2 gives you a little lower required minimum distribution, which allows you to stretch it a little longer. Table 1 is for an inherited IRA. You may want to consider taking your RMD earlier in the year. Most folks figure that they want to leave it to the very last minute in order to maximize the length of time at which you're earning tax-deferred dollars. The problem with that, well, there are a couple of possible problems. First issue is that the IRS has a first dollars out rule. So if you're doing a Roth conversion, you have to be very careful that you take your RMD first and then do the conversion, because you can't use the RMD for the Roth conversion. If you do them in the wrong order, the IRS can get a little upset about it, and you may wind up, well, it's a hassle to undo it. I'm not sure if it can. I'm not sure what it takes to undo it. So, especially if you're doing or thinking of doing a Roth conversion, consider taking your RMD earlier. You definitely need to do it before the Roth. The other issue where you might want to consider doing the RMD a little earlier is that if you pass away during the year, the estate the RMD has to be taken by the estate, not by the heirs. And you don't want to leave your heirs a challenge of trying to figure all this out at the end of the year, how to take it out of the estate, especially if, as is likely to be the case, some of the accounts are frozen by the state for 40 days. So it's cleaner to take it out earlier in the year. Qualified charitable distributions are a great deal if you're charitably inclined. The QCD avoids tax at the ordinary income rate, and it doesn't even show up on your 1040, so it doesn't add into the AGI, and that's important because the AGI is what's used to determine the impact on your Medicare Part B cost. You must be over 70 and a half to use the QCD. I think the 70 and a half is still applied there. I don't think that got bumped to 72. I'm not certain. One of the rules, though, of course, is that the contribution must go directly to the charity, not to a donor-advised fund. So if you want to use a donor-advised fund, you can't use a QCD. And there's a limit of $100,000 for QCDs. Another approach that's almost as good is to just take sell an appreciated stock from your taxable account. Your taxable income won't be impacted by it because you get the deduction for the charitable donation, but your AGI will go up, and that may be a problem if you're making Medicare Part B payments, because it may bump you into a higher payment, and we will discuss that in a few minutes. How that can be a serious impact. We'll look at that later. Both of these strategies could and should be tied into rebalancing your portfolio. If you're taking money out of any of your accounts, you should use consider using the advantage to rebalance your portfolio at the same time. We talked about safe withdrawal rates, Bengen's 4% rule. In 1994, he wrote a paper that was a landmark in the industry, advocating a 4% rule under certain conditions. And the conditions are that you have to have the bulk of your estate in equities, with 25 to 50% of it in fixed income, and you take 4% the first year, then you can increase it by inflation subsequent years. And he found that historically, looking at the data all the way back to 1926, that the worst case 35-year period allowed you to pull out 4% per annum without going broke. And later work that he did shows that if you add small cap stocks into the mix, that can get bumped up to about 4.5%. Other folks, Geaton and Klinger in particular, but there are other people who've looked at this concept. They figure if you put certain safety guard bands in there, say if in the years that the stock market is down, you back off from taking your inflation increase and stuff like that. If you put those safety rules in, that you can bump up the initial withdrawal rate to as much as 5 or 6%. On the other hand, Fow and Doken are much more pessimistic, and they figure that because the fixed income is negligible these days compared with the situation when Bingen was looking at at his data, that the 4% rule may be overly aggressive, and they actually advocate something closer to 2.5 to 3%. Sun and Webb have an interesting approach where they just go to the IRS table and look at RMD tables, table 3 that we discussed earlier, and if they if you use that table, then you can get if you use those figures, it's actually a fairly conservative distribution pattern. And it's very simple to follow. So the takeaway for retirement is open a Roth IRA for your grandkids. As soon as they have a few bucks from a paper route or mowing the lawn or whatever, and in order to entice them to contribute 100% of what they earn into the Roth IRA, I'd suggest you reimburse them 2x, maybe 3 or 4x, just to get their attention. It's a great way to get them started and set up a pattern for life. On the back end of the retirement planning, when you're looking at withdrawal rates, if you find yourself looking at more than 4 to 5% or needing more than 4 to 5% per annum, you probably need to sharpen your pencil really carefully and recognize that you're probably taking some risks and they need to be identified. Next, we look at risk management, better known as insurance. I don't want to slight insurance brokers, but insurance is inherently costly, and there's nothing personal here. The reason it's costly is because the premium that you pay has to cover the actuarial cost of whatever you're insuring, be it homeowners insurance or life insurance or whatever. The insurance company will have some overhead that has to be covered, and the insurance company is entitled to make a profit. They're not supposed to be a non-profit organization. So when you add all this together, the cost of the premium may be surprisingly high. But the insurance company does have an advantage. They can play the large numbers game, which you can't. If you're talking about, for example, life insurance, you don't know whether you're going to live to the average, mid-80s or whatever, whether you'll die early or you could live 10 or 20 years longer than that. You don't know on an individual basis. But the insurance companies, their actuaries know to the day, what the lifespan is for the average person, because they're looking at hundreds of thousands of people. So they can play the averages game and you can't. Insurance works best for events that have a low probability of occurring, but a life-altering cost if it does occur. I mean, think, for example, of your homeowner's insurance. It's highly unlikely that your home is going, hopefully, well, maybe things have changed. I was going to say it's highly unlikely that your home is going to burn to the ground in the next 12 months. That may be an unfortunate time to use that analogy. But if it did occur, obviously, and was not insured, it would put a huge hole in your retirement plan. In general, I think you should buy insurance to manage the risk for life-altering events, potential train wrecks. I'm going to hit 3 of those in a minute, and that you should self-insure for the small items, because for the small items, there's no need to incur these additional adders. Okay, talking about train wrecks, the first one I want to look at is longevity. What happens if you live to 105? That's great if your retirement portfolio lives to age 105 as well, but it may be a challenge to have that happen. And it may be simpler to consider passing some of that risk on to an insurance company, a professional corporation that's set up to deal with that risk because of their ability to average the amounts. So the first thing you might want to consider would be an immediate annuity, where you give a lump sum premium to the insurance company, and they immediately start paying you the equivalent of a pension for the rest of your life, regardless of whether the rest of your life is age 75 or 85 or 105. I've given you some typical numbers for today. Typically, if you want $1,000 per month pension, you need to give them a premium today of about $210,000, and the cash flow from that works out at roughly 5% per annum. And I'm talking about if you make this deal at age 65, that obviously changes as you get older. The amount will be less. This is not. Don't confuse this with a bond yield or interest or anything like that, because a lot of what you're getting back is your return of capital, not just income. Another interesting approach is the deferred annuity, longevity annuity. In that case, you might pay them a one-time premium now and say, I want to collect a monthly payment for the rest of my life, but I only want it to start at a certain age. And if you're currently age 65 and you want to start at age 85, you would need to give them about $40,000 today, and they'll give you $1,000 a month for the rest of your life from age 85 on. In this case, you get a much higher cash flow, and in fact, if you were 75 or whatever when you made this deal, this can go up to 50 or 60%, because some of the folks making this deal won't reach, will die before the age. And it's not that the amount is wasted, but the unfortunate folks who pass away early, their contribution is going to, it allows the insurance company to bump up the payments for the folks who are fortunate enough to live longer. So I would suggest considering an annuity as one form of avoiding that train wreck. If you have an adequate retirement portfolio that covers you to age 95 or 100 or 105, and you don't consider this a risk, then you probably don't need an annuity. But that's a challenge. For example, if you purchase a deferred annuity, it means that you only need to make your retirement portfolio last to a period certain, to age 85, and the insurance company worries about what happens beyond that. So it allows you to bring some certainty to your long-term planning and have the insurance company take up the risk, some of the risk. Another potential train wreck is long-term care. Long-term care can be fairly expensive. The data shows that roughly 2/3 of the folks over age 65 will need some long-term care in their lifetime. The average length of stay is 2 to 3 years. The cost can be fairly high, over $100,000 per annum. You do not want to make the mistake of arguing that, well, I can cover $100,000 for 2 or 3 years. That's not a problem. Those are the averages, and the insurance company can look at it that way, but you can't. So the question occurs, what happens under worst case conditions if, for example, you were inflicted with a dementia problem and managed to live physically comfortable but unable to take care of yourself for 20 years. So it's worthwhile considering a long-term care policy. You may not be able to get these days policies. They don't write them, I think, anymore that go beyond 5 years, and that's a shame. But in order to get beyond that, you may be able to get a life insurance or an annuity with long-term care benefit rider. Third train wreck is liability litigation. If a teenage child is at fault in a freeway accident, something like that, you can get into a multi-million-dollar suit all too easily. So you have some coverage from your auto insurance and your homeowner's insurance, but you may need to buy a separate umbrella policy to cover beyond that, and they're actually fairly cheap. It'll only cost you a few $100 a couple of $100 per million insured. Social Security is one of the insurance issues, and I've shown you here how to calculate your Social Security. And for the full retirement age, for most of us, it is 66 these days, 66 or 67, or working towards 67. You can retire early, but you pay a penalty of 0.5% for each month you retire earlier. I think that works out at 25% cut in your benefits if you retire at age 62 and your full retirement age was 66. On the other hand, if you delay retirement to age 70, you can get an 8% per annum bump. So for a 4-year delay from 66 to 70, you can get a 32% increase. Spousal benefits can be 50% of the worker's benefit, and on the death of the worker, the survivor benefit is 100% of the worker's benefit. So that's why it's worthwhile for the higher earner. It's usually worthwhile for the higher earner to make sure that they maximize their benefits by deferring onto age 70. Medicare, you got to be careful with. Most folks are familiar with the Part A, B, C, and D. The Part B premiums are, I think, this year about $145 a month. But be careful of the IRMA, the income-related monthly adjustment amount. This is what we talked about earlier. That's based on your AGI. If your AGI goes above certain limits, you can pay as much as $347 extra per month over and beyond this, so it can get expensive in a hurry. Also be aware that Medicare has limited coverage. Once you go outside of the US, you're no longer covered by Medicare. So for folks that travel, you may want to consider a Medigap, or even if you don't travel, you should consider a Medigap policy. Also, there's negligible long-term care benefit from Medicare. It's only if for a few months after you're hospitalized. And again, you should consider a separate long-term care policy. So the takeaway for insurance is that it's not an investment. What you're doing is paying a third party to take on some risk that is more than you want to bear yourself. Beware the train wrecks we've just discussed, and recognize that Social Security and Medicare are complicated, and so you need to be careful with your decisions there. The final pillar for our estate planning is, or for our financial planning, is estate planning. Major documents are your will or your revocable living trust. There are major differences here. The will is fairly cheap, a few $100 for a typical standard will. It's effective only on death, so you cannot provide for incapacity. That's one of the drawbacks. The other drawback, of course, is that it must be probated, so that can be very expensive. The revocable trust avoids both of those issues. You can use a trust to accommodate for incapacity, and it does avoid probate. So even if this costs a couple of $1,000, it can still be the cheaper solution in the end. We're going to talk about probate in a minute, and you'll see where the cost differences come up. Other documents you may want to know, what you should consider, your power of attorney for financial and legal matters, and also your healthcare directive. You need to appoint people for both of those cases, for both of those situations, to take care of the situation where you are no longer able to take care of, manage your own affairs. Again, it's easier to do this. It's typically done within a trust, but if you have a will, these need to be separate documents. You may want to write a letter of intent, an informal, non-legal document that takes care of the disposition of personal items, small items, typically sentimental value, and may also include comments on what sort of funeral arrangements and so on your preferences might be. You also may want to pass on your values in an ethical manner. Probate is the judge has to determine the validity of the will. So that's what probate is all about. And the judge actually appoints the executor. You might think that you appoint him in your will, and you can make a suggestion in the will. Usually the judge will appoint that person, but he can overrule your decision. Probate has a number of disadvantages. We'll look at those first. It's highly complex. It's time consuming. It can be months or years. There's total lack of privacy, and it's expensive. Having said all that, there are some benefits to probate that may be useful, but probably they get overwritten for most people by the disadvantages. It forces the creditors to claim within a certain time frame, 4 months usually. The court supervises the distribution of the assets, which is helpful. If any of the properties have a cloud on the title, going through the probate process clears that title, which can be useful. And the other issue is that if the heirs are fighting amongst themselves, the probate court can act as referee, and that can be helpful. Successor trustee, what are his or her duties? Read the documents first, make sure you want to do it. It's a great honor, but it's really time consuming and hard work. So before you jump to accept it, just figure whether you're willing to do all of that. After the death, the trustee has a hectic week or two, selecting funeral homes, arranging for the services and burial or cremation. Notify the Social Security and the bank accounts. Bank accounts may actually get frozen for 40 days, which makes it tough when you're trying to keep the water and power and so on, keep those bills paid. Legal and financial issues, you need to retain an estate attorney. Typically, that's very often the attorney that wrote the trust in the first place. It doesn't have to be. You can file for a new tax ID. A whole bunch of stuff that you got to work through in safeguarding the documents. If there's a house involved, if this is the second spouse to die and the trustee has to sell the home, well, you folks all know as well as I do the challenge that can be. It was, again, a fair amount of work. You need to keep meticulous records. And when you're distributing the estate, most folks suggest that you distribute two-thirds of it as soon as you can, but hang on to 1/3 of it for 3 years in case there's an IRS audit or some challenge, because if you've already distributed the full thing and the IRS audit goes against you, it can be really tough getting the assets back, and very often, but you're potentially liable yourself for any assets that were distributed that you can't get back. One thing you need to consider is whether your trustee has access to your digital world, either when you die or if you become incapacitated. Do they have your logon ID and password so they can get access to all of this? You also need to make sure that you've given them the authority to do this, especially in your trust. It's useful to authorize them to do all of this. It saves them having to, frankly, bootleg access illegally sometimes. I want to very quickly hit on California's right to die law that was passed in 2015, became effective 2016. Again, it sunsets in 2026 unless there's further action taken. I'm not sure if that's still the case or not. There are two situations where this is not as helpful as you might hope it would be. You cannot use it for if the patient is comatose, and you cannot use it if the patient has dementia or Alzheimer's disease. the patient must have the mental capacity to make their own decisions, which rules out anybody with dementia, and the patient must have the physical capacity to self-administer the drug, which kind of rules it out for comatose patients. I can understand why those constraints are in there, but on the other hand, it means that your healthcare power of attorney agent cannot act for you in this case. So you need to make decisions early if it applies. So for estate planning, the biggest takeaway that I would leave with you is just do it. Don't wait until you have everything perfect and optimized, because it'll never happen. Get something down on paper as soon as you can. And that applies to folks in their 20s and 30s. As soon as you have own any property at all, cars or even a small savings account or checking account or retirement plans and all of that, you need to get something down on writing. And maybe a simple will would apply then, but just do it, and you're going to be revisiting it every few years anyway, so you can tweak it and fine-tune it at a later point. Final shot here would be for beneficiary designations that are very, very important. With your any life insurance policies or IRA account, stuff like that, how they do not pass by the trust, they pass by the beneficiary, by contract, by the beneficiary designation. So make sure that any old beneficiaries are taken off, and that whoever you have on there is your current beneficiary. You don't want an old spouse from a divorce or whatever to still be on there. So that's a quick overview of all of the pillars of the financial planning. And the question was, how much of this can you handle yourself? Harold Pollack was on a radio show back in 2013 and boasted that he could fit all of the retirement plan, financial plan issues that were of any significance onto an index card. Somebody challenged him to do it. So this is what he came up with. And for most people, this may well be adequate. I'm not going to go through it now, but you may want to print out the slide. You'll enjoy it. It's got some good stuff on it. And it's a good summary of what you would need to do in practice for a financial plan. If your situation is more complex than this, you may need to look at getting some professional help. And the first criteria is: are you comfortable with all the numbers game? Are you comfortable with the concept of time value of money, future value, present value, so on, uneven cash flows, internal rate of return? Do you enjoy playing around on Excel spreadsheets? Do you have the time to manage it yourself? If you're working full time, you may not have the time to do all this, even if you have the capability. And this is equally important in my mind. Do you enjoy doing it? If you don't enjoy doing it, frankly, it's probably not going to happen. So that could be a time to look at hiring a professional to do it for you. As we age, we may not be as sharp as we once were. We may not be able to manage it ourselves. Obviously, estate planning is not a do-it-yourself job. You should hire a competent attorney there. For a financial planner can help you with a whole host of areas. The first one is almost going back to the life planning that we started with. He can help you set realistic personal and financial goals. And he should have a good enough feel for all of that to know what is realistic. Most folks, when they think of a financial planner, think of a portfolio manager, and that's certainly something that most of them can do for you if you need help. But it goes, financial planning goes way, way beyond portfolio management. He can help you generate, a long-term retirement plan. He can help you optimize your tax strategy over multiple years, which you can possibly do yourself. It's just a matter of, it can be, a fair amount of work, but it could be important. He can review your insurance coverage and your estate plan documents. So those are the kinds of things that you can get help with if you feel that you need it or want it. How much help do you need? Do you need help with everything? You're just basically saying that okay, financial planning is, I've got a complex situation, I need help across the board, then you should probably look at retaining a financial planner, either a CFP, a certified financial planner, or a chartered financial consultant. If you just want help with your investments, it's very easy to just hire a portfolio manager, and these may or may not have these designations. He will have an RIA designation, which merely means that he has passed a Series 65 test and is authorized to charge a fee for financial advice. That's basically all that the RIA designation means. And he won't necessarily have any expertise in taxes or insurance and stuff. May do, but not necessarily. For help with your taxes, you may want to go to a CPA or an enrolled agent. Enrolled agent is authorized to represent you before the IRS if you ever get audited. Or you can figure that you can do it all yourself, except for the estate planning, of course. How do you know that the planner has your best interest at heart? Some folks that hold themselves out as financial planners are actually salespeople, maybe brokers that work on commission, and their only legal requirement is to sell you a suitable security. Suitable is a rather loose definition, and it can mean whatever they want it to mean. But most of them are. I'm not saying that they're dishonest or not reputable. Most of them are, but the potential is there to come across a bad apple that puts a very loose definition in this. And obviously, if they're selling you stuff on commission, they have the conflict there that they may be tempted to sell you stuff that gives them the best commission, even if it is on a loose definition suitable for you, but not necessarily the best one for you. Somebody with a fiduciary relationship is pledged to act in your best interest, and that's important, at all times. If there are any conflicts of interest, they're bound to disclose them and discuss them with you and let you know how they're working around them. If you hire a certified financial planner, CFP professional, they will automatically have a fiduciary relationship, and there may be others that will do as well, but you need to check on that. How is the financial planner paid? Garrett Planning Network sells their time by the hour. I think this is Michael Kitz's who goes on a monthly subscription. You can do it by the project. You can basically say, I need a retirement plan, and they'll say, well, that'll be so many dollars, and just for that one project. What's typically happens for portfolio managers is they charge a percentage of the assets under management in this sort of range, or in some cases you can pay an annual retainer. You may want to check out the Financial Planning Association and the National Association of Personal Financial Advisors, NAPFA. Both of those, you check out their website, and I'll give you the website in a few minutes, are good places to start looking. How do you hire one? Be very clear. Do your homework first. Be very clear on what you want. You should interview at least 3 candidates, and most of them will give you 30 minutes or an hour for free, because they want to make sure that you're a suitable match for them just as much as you want to check that they're a match for what you need. These are sort of questions that you can and should ask, including how they get paid, whether they truly have a fiduciary relationship, etc. So the final takeaway, we're back to Yogi Berra. I love Yogi Berra. We don't know where we're going, but we're making good progress. Start with a clear goal. Know where you're going. And my final shot would be that there's so much more to financial planning than spreadsheets covered with dollar signs or percent signs. The dollars are important, but a lot of the decisions are on the soft side, and they're perhaps more important. What I'm giving you for the rest of it are slides that you may want to download and look at, because I include a bunch of further reading material on investing, on taxes, on retirement, on insurance, on estate planning, financial planning, I give you some websites here that are useful. Second page of websites. And finally, our mandatory cartoon. I love the Lockhorns. Leroy's a certain lifestyle he wants to maintain. Yeah, it sure looks like it. Anyway, I hope you got something useful from this talk, and I look forward to a meeting with you again next month. Thank you.